How bankers stole the American dream right out from under your nose. America's drowning in cheap imports, and it has a shocking price tag. Today, we're tearing into the real cost of the U.S. trade deficit and how we actually pay for all those imports. We'll look at the avalanche of foreign capital and the effect that has had on everything from the stock market to home prices. Did you know that the trade deficit has hit 6% of GDP only twice before in American history, right before the 2008 GFC and now? Here's the truth about how our trade deficit is fueling enormous asset bubbles. Stick around to the end to see the shocking amount of foreign dollars that have flowed into U.S. real estate over the past 15 years. So many people are probably aware the U.S. runs a trade deficit. We see that here in red. Well, for the purposes of this video, it's important to know that there are two main accounts when discussing capital flows and kind of international accounting, international economics. There is the current account and the capital and financial account. We will take a look in a sec, but the current account, as we can see from this chart, is basically the balance of trade. This is one scale for each of them. It's a quarterly figure, so a $414 billion trade deficit, $450 billion current account deficit. But as we can see, they are essentially the same thing. Here is the last current account report. And there's a couple notable points here. The current account deficit, put another way, the trade deficit, increased by 44% to that $450 billion for the first quarter of 2025. Now, they note that this makes up 6% of GDP. Here is the components of the current account. We can see services. The U.S. runs a slight services surplus, meaning we export more services to the world than we import, but we run a massive goods deficit, a trade deficit in goods. And there are two other minor components with the current account, so what's called primary and secondary income. But as you can see, they make up very, very little portion of the overall current account. The current account is basically the balance of trade, as we could see from that chart. Here's another way to think about it. Here in red is the import of goods and services versus what we export in goods and services in blue. The difference between these two lines is the current account deficit. Now, if we exported more goods than we imported, we would run a current account surplus, of course. Well, how does this deficit in the current account get financed? It gets financed by foreign capital flowing into the U.S. This is how we pay for all those goods, that goods deficit. Here is the capital and financial account. This is only looking at the financial account, but the capital and financial account refers to all the capital that is flowing from the rest of the world into the U.S. Here we can see what's called direct investment, foreign direct investment, or FDI. That is in gold. And then portfolio investment is in gray. Portfolio investment is basically foreigners buying U.S. stocks or securities in the U.S. We can see what's called the liability side, net U.S. incurrence of liabilities. What this means is that foreigners have purchased these goods, these financial assets from us, and they own it, not the U.S. And we can see that as the current account deficit gets worse, this incurrence of liabilities or foreign purchases of U.S. financial assets goes up. In fact, they are just the mirror image of one another. As the current account or the balance of trade, as we were looking at here, they're basically the same thing. As the current account deficit or the trade deficit gets worse, right now about $1.8 trillion per year on an annualized basis, that means the mirror image of that is that 1.8 trillion US dollars must flow in from the rest of the world into US financial assets. They are two sides of the same coin. They are mirror images of one another, as we can see. This is how everything nets out and balances. Now, even Wikipedia and The Economist, both of which are very pro-globalization, even they were forced to admit here in this article for the Great Recession that The Economist wrote in July 2012, the inflow of investment dollars required to fund the U.S. trade deficit was a major cause of the housing bubble and financial crisis. The trade deficit, less than 1% of GDP in the early 90s, hit 6% of GDP in 2006. That trade deficit was financed by inflows of foreign savings. And so, again, even The Economist notes this. Now, we're talking about a $1.8 trillion inflow per year into financial assets. That is how our trade deficit or our current account deficit, that is how it gets balanced. That is how we pay for all that stuff is foreigners are buying all of our assets. And we'll see the effect that this has on asset prices in a second. The cumulative flow of dollars from the rest of the world directly into US real estate will probably blow your mind. We'll get to that at the end of the video in a sec. Here's the current account as a share of GDP, and we're looking at it inverted, right? We know the current account deficit. Here we inverted that. So this is another way to think about the capital and financial account surplus as a share of GDP. And what I want to point out here, of course, this has a correlation to home prices, but it's kind of hard to see from just the nominal home price chart there in pink. So what I did is I took the rate of change of those home prices, and it's over a 24-month period. And what we can see is that as the trade deficit or the current account deficit gets worse, put another way, the capital and financial account surplus gets better, goes up, increases. As the trade deficit gets worse, we can see that the rate of change of home prices goes up during this period of time here, as well as here, as well as here, and as well as here. Now, of course, there's a big kind of hole in this chart, which is the single family home prices, the rate of change of those home prices here did not correspond to a change in the current account. Well, this was due to Fed. The Fed was purchasing $1.8 trillion in mortgage-backed securities in this green box that I've highlighted. This has a direct impact on home prices. It lowers the interest rate on mortgages. It's subsidizing risk. And fuels demand in the housing market. This is what they did to bail out the housing market. Well, it worked. We can see that home prices, were contracting at about 15%, but they started to rise. And we can see at the peak here, they were increasing at 32%, where my cursor is here. Well, then, of course, home prices started to fall. And the rate of increase started to slow. It's probably a better way to put that. But the current account didn't really change. So why did this happen? Well, quantitative tightening is the exact opposite of QE, where the Fed is printing money to buy assets. In quantitative tightening, it's the exact opposite. They are letting those assets mature and roll off their balance sheet. And sure enough, home prices, the rate of change did start to slow in home prices as the Fed was engaged in quantitative tightening. Here, I just synced up the green and red boxes so you can see here is the Fed holdings of mortgage-backed securities, and I synced up the dates. So the green box here is synced up to the green box there in terms of date. It's pretty clear that the only kind of deviation from the current account was due to these Fed purchases and then sales or maturation of mortgage-backed securities in the green and the red box, respectively. So, of course, $1.8 trillion per year. Here we're looking at that capital and financial account surplus on an annual basis. Of course, $1.8 trillion per year flowing into assets in the US must have an effect on stocks too. Well, sure enough, it does. And here we're looking at the Dow Jones Industrial Average. This is one of the major stock indices for major companies in the US, a basket of US companies. Hopefully, the correlation is very clear where you can see as the capital and financial account surplus is growing due to our trade deficit getting worse, the stock market does better and better. Here is the rate of change of the white line, the capital and financial account, and then here's the rate of change of the Dow Jones Industrial Average. And hopefully, you can see the correlation as the trade deficit gets worse, meaning the capital and financial account must go up, the surplus must increase. As that happens, it correlates to a higher rate of change in the price of US stocks. Hopefully that is clear. So here's the current account versus the Dow Jones Industrial Average. Remember, the current account is just the inverted capital and financial account. So here we're looking at the current account and then the Dow Jones Industrial Average. Well, I ran a correlation coefficient down here. This shows mathematically how strong a correlation is. And because the current account is going down and the stock market is going up, because remember, the current account is the inversion of the capital and financial account. This is the trade deficit. But as the trade deficit gets worse, if the stock market goes up, at a faster rate, you would expect what's called a negative correlation coefficient. That is what we see in blue. It has a very, very strong negative correlation of here in the 80s, 0.89. And then here during this period of time in kind of the early 2000s, as the trade deficit was widening and globalization was really picking up, we can see it had a very, very strong correlation or negative correlation of 0.82. What this means, as the trade deficit gets worse, the stock market goes up. That is the correlation between the two. Because remember, what must balance a current account deficit is a capital and financial account surplus. So you would expect a negative correlation. As the trade deficit is getting worse, the stock market goes up. Well, again, you might be looking at this period of time where the correlation was starting to break down. Well, of course, this was when the Fed was printing $6.8 trillion to expand its balance sheet. Again, I've synced up the green boxes so that you can see that really the only period of time where the correlation broke down since the 1980s was during this period of time when the Fed printed $6.8 trillion to buy financial assets. So all of this was sparked by a bunch of posts that I've been seeing recently of people lamenting foreign purchases of U.S. real estate. And so this is why I made this post here this morning, why we're doing this video. There is a severe lack of understanding of these simple truths. A current account deficit must be balanced by a capital and financial account surplus. This is just basic international accounting, international finance. And so I decided to look into how much money has flowed into real estate specifically as a result of our current account deficit. We know 1.8 trillion must be flowing into some assets. We established that that is comprised of portfolio investment, which is direct purchases of securities and things like that from foreigners. But then foreign direct investment, this includes purchases of real estate directly. And luckily for us, we have disaggregated data from the BEA. So we can see how much of this foreign direct investment is going into real estate. And this is in millions of dollars. I will link to this table. It also includes a breakdown per country of how much money is flowing from each country into the US or out of the US. And so you can see that in the description. I will link to this. And remember, this is in millions of dollars. So this would be $7.8 billion flowed into FDI via real estate in that year. I can't see which year it was, but this goes back all the way to 2011. And so it's important to kind of total up all of that FDI. And if you do, generally speaking, of that FDI, that total FDI, which was $350 billion for 2023, of that FDI, about 20% of FDI is foreigners purchasing real estate. So this equates to $60 billion just in the year 2023. Well, that translates to 135,000 single family homes. But wait, it gets worse. So FDI, or direct purchases of real estate itself, is not the only real estate related a way that foreigners can influence via that capital and financial account surplus. There's also mortgage-backed securities and REITs. A REIT is a real estate investment trust. And you can find these in your brokerage. They trade as basically as like an ETF, but it includes real estate. Mortgage-backed securities, we established earlier, these are a collection of a bunch of mortgages. It's basically a fancy bond. What secures the bond is the people paying their mortgage, the thousands of people paying their mortgage, and of course the real estate that is the collateral that kind of underwrites that mortgage-backed security. Well, they can pour money into these mortgage-backed securities in REITs. This is recorded under a different category. This is that portfolio investment that we were looking at here in gray. So if we include those mortgage-backed securities and REIT purchases, it gets even worse. So there's about $200 billion for the year 2023 in portfolio investment total. About 10% of that, according to the papers that I was able to find, about 10% of that goes into REITs and MBS. So that equates to about $20 billion or 45,000 single family homes. So if you total the two of those up, direct purchases of real estate by foreigners, plus purchases of things that directly influence real estate prices or affordability. If you total those two up, the portfolio investment of purchases of MBS and REITs and direct purchases of real estate itself, just in the year 2023 alone, there was $80 billion which represents about 180,000 single family homes. This was just for the year 2023. Of course, we've been running an ever larger trade deficit for decades. This is just for 1 year. $80 billion flowed into the real estate sector from foreigners. I make a note that, of course, not all this money is flowing into the single family home market. Some of it's going into commercial real estate. So hopefully, the point there is to illustrate the scale of the problem, the scale of this structural bid into U.S. financial assets from foreigners. It is required. It is a direct requirement or direct result of running such large trade deficits. Over the past 14 years, the cumulative sum of this direct purchase of real estate by foreigners via FDI is $140 billion. If you take the average home price over the past 14 years, that equates to about 400,000 single family homes. And again, this is just direct purchases of real estate itself. It's not including that portfolio investment via REITs and MBS. So it's actually even worse than this. And then finally, we'll just end here. Here is that inverted current account. Put another way, the capital and financial account. The trade deficit is getting worse, right? It's the mirror image of the current account, which is simply the balance of trade or the trade deficit. As the trade deficit is getting worse, we can see that the net worth of the top 1% as a share of GDP increases. Now, of course, again, your eye might go to this kind of divergence. This green box is synced up to this green box, which shows that the Fed's purchase of financial assets via its quantitative easing program massively benefited the top 1% and the net worth of the top 1%. Remember, this white line is a ratio. So as the net worth of the top 1% is increasing, it's increasing faster than GDP. That is what forces the white line to go up. The net worth of the top 1% can't just grow with GDP. If it's growing at the same rate as GDP, this white line would be flat. It would be horizontal. But instead, what we see is the white line going up as the trade deficit is getting worse. And the reason is that there is that mechanical structural bid into U.S. financial assets from foreigners. That is the other side of the trade deficit. So anyways, hopefully that was helpful. Hopefully that was educational. If you think that this is all worth it, of course, this is what's driving wealth inequality. Those that own financial assets have the structural bid behind them of foreigners recycling dollars into the capital and financial account. So, if you own financial assets, you have done obscenely well. Maybe you think that this is all a great thing. Leave a comment if you think that, and leave a comment if you think that running such a large trade deficit and therefore a large capital and financial account surplus, leave a comment if you think that that is maybe not the best thing, and maybe we should try to balance trade, which would, by the way, bring down the amount of capital that is flowing from the rest of the world into U.S. financial assets. Anyways, hopefully that was helpful. Hopefully it was educational. I would be curious to hear, should we try to improve the trade deficit and bring this amount of foreign capital down? Or should we leave it as is and let it just keep going on its trend toward the moon? Leave a comment below. I'm curious to see what everyone thinks. Hopefully it was educational, and I will catch you on the next one.